Okay, guys, so as promised, I am going to give you guys module 10 of this Forex hybrid course, and this is a very, very valuable course. So I'm about to give it to you guys free of charge here on YouTube, and I hope that you guys pick something out of it. So I earlier posted in my Telegram asking people to, show me interest that they want to see this module, and I'm actually bringing this out here instead of keeping it in the paid group because I feel like even though you guys are part of the free community, you are still very, very important, and you guys also need some degree of honesty and transparency. So I'm bringing this video to you guys, and I really hope that this video helps you out in one way or the other. So this video is part 1 of module 10 of my Forex hybrid pro course, and this part 1 is going to cover mostly the introductions and typically what we are going to be looking down the line as we go deep in risk management. So this video is covering risk management alone, right? So we're going to see the introductions, where we're going to look at, and some key points that we're going to take away from this video. So stick around to the end and do not miss any part. Subscribe if you're not, and use the links down below to get to me if you want to be part of my private mentorship. Okay, guys, welcome back to module 10 of this hybrid pro course. So in this module today, we are going to talk about risk management. So we're going to discuss the basics of risk management. When I say the basics, I mean the introduction. Okay, so we're going to discuss the introduction to risk management, what it's all about, the key points that we have to look at. Then we move over to the practical side of it, because risk management is an entire topic of it's a topic on its own, right? So we are going to discuss the theoretical section of it, which is going to be more of introduction. Then we will go over to the practicals in part 2. So this will be part 1 of this pro course. Then part 2 will follow up after this. So let's get into it. What is risk management? As you guys can see on my screen, if you can take a screenshot of this, then that would be good, right? So you can read it after, or you come back and watch this video anyways. Still the same thing. So risk management is the process of measuring the size of your potential losses against the original profit potential, right? On each new position within the financial market in order to succeed as a trader. So in order for you to succeed as a Forex trader, you need to be able to know exactly how much you put on every trade you take. What is your risk? What is your stand on this point, on this particular trade, on this setup? Okay, what do you look to take out of this market? And what will you do if things do not go as planned? Let's say you sit on your arms and you spot a very, very good ACP area. Let's say a category A setup, right? And you look like, okay, you want to put money on this trade. So how much are you willing to put on that trade? So first of all, you have to put your account balance in consideration. But I don't really care how much you have as your account balance, even if it's $1. I want you to make sure that on every trade, you have just 1% on that trade. So if you're looking at that setup, what's your takeaway? What is your plan? What do you have at the back of your mind? So first off, you have to look at it and say, okay, there are two outcomes, like I said, and I always say it. The market will either go up or down. So if you're looking to sell, you need to also look at the possibility that the market might go up. So if the market goes up, which is not in your favor, what will you do? How will you manage your trade and how you get out of it? All of that is going to be in the practical section. Let's continue with this. Okay, risk management helps cut down losses. It can also protect traders' accounts from losing all of its money. The risk occurs when the trader suffers losses. If the risk can be managed, traders can open themselves up to making money in the market. After all, a trader who has generated substantial profits can lose it all in just 1 or 2 bad trades without proper risk management strategy. Okay? It makes a lot of sense, doesn't it? So let's say we've been managing our trades, or we've been managing our trades for like a week, and we've taken let's say $500 profit, right? We've made $500 profit in the course of 5 trades. Every trade we made $100 with proper risk management. We've made $100 with proper risk management per trade, and we've taken 5 trades in total. That leaves us at $500 in profit, right? Now, let's say we happen to over risk, or we ignore our risk management, right? We ignore the risk management plan, we ignore the risk, and we just enter the market like there was nothing, there was no red flag. Then we just see a setup, and we decide to just open the setup. We go all in. We screw off stop losses, screw take profits. We just want to enter the market without any of those things, and without properly calculating our lot sizes to know exactly how much we're putting on a trade. So we just open it blindly. All of that money, all of the profits you've made the previous week will be swallowed up in that particular trade without the market even having to do anything. Just move like that and you're done, right? So this is how risk management is very, very important. You might have a good entry, a good placement, a good setup, But if you do not know how to control your risk, how to calculate your lot sizes, you might enter the wrong lot on that particular trade. Like let's say you have a $1,000 account and you mistakenly open like two standard lots. The market just needs to move like 2, 3, or 10 pips. You're done. The market just needs to push just a little. You're done. It blows your account in no time. Just 10 pips in drawdown, you're out. 20 pips in drawdown, you're out. Right? Even though that's a good trade, and maybe it's going to train a bit in drawdown, it's going to like hover there a bit, then eventually go into your target. But you're out. You're stopped out on that trade because you opened, you had wrong lot sizes on that trade. You opened very, very large lot sizes because of poor risk management. So now the market normally does not just enter your key level and just drops. It has to like, consolidate, trend a little, like, it's going to fluctuate up and down in your drawdown before eventually going in profit. So now that time that the market is making or spending in that drawdown or in your red zone, you're going to panic as a result of bad position sizing and bad trading techniques, right? You're just going to end up closing that trade, or maybe the trade might end up blowing your account without even reaching your stop loss because it's floating a lot of money in drawdown. So you need to know how much you're putting on your trade and how much you're willing to take out of that trade. So let's continue now. Let's look at the key takeaways. Okay, so there are 3 points here. Let's look at the first one. Trading can be exciting and even profitable if you are able to stay focused and do due diligence and keep emotions at bay, right? As a trader, you need to be able to stay focused on every trade you take, be it a losing trade or a winning trade. You can take a trade that's not good, it's going against you, but if you can be able to stay focused and find a way out of that situation, which is maybe waiting for the market to pull back into your entry, then maybe you close at break even, or you wait for the market to stop you out, you still stay focused, then you wait for the market to retrace back to that area so you can take the opposite direction, right? That's exactly how to stay focused. And now for your emotions, emotions, you cannot just manage I cannot teach you to manage your emotions like that. I'll give you some key factors, I'll give you some points, okay? I'll give you some tips how you can do it. I feel like this particular part here is not something that you can just learn in one video and know how to manage your emotions. So every human being has emotions, and I don't care how long you've been trading for, you still trade with emotion, unless you're not trading real money. If you are trading real money, you will have emotions. Even if you're in profit or you're in drawdown, you still have emotions, because if you're in profit, you just feel like, okay, maybe let me just take the profit here. Maybe the market might pull back all the way to my entry, and all this money floating in profit will just go to waste. Let me just take it and leave, right? I'll still be okay. Then another trader will be like, okay, since it's running in profits, the guy's like, I think I can go for more. I can double this thing. Let me just hold it. Let me hold it. And then it will go back to entry. So all of these things are emotions, right? They do fluctuate. So you have to stay focused and determined and disciplined. So even if you're in red, if you're in drawdown, you're suffering in drawdown, hold your positions. I've sent you guys a bunch of examples. I've taken a lot of trades with you guys, and you guys have seen how it plays out. You guys have seen how the market spends like 4 hours in drawdown. I mean, 4 hours, for 8 hours in drawdown only. Then it takes just like 2 to 3 hours to reach TP1. Because when the market wants to move, it moves. Okay? But before the market moves, it usually consolidates. That consolidation is what I call accumulation. So when the market has accumulated, what happens is it ends up distributing. It distributes it, like it shoots up after compressing all of that gas. Let me put it like that. Then when it finally explodes, right, it just goes over the place. That's what I'm trying to say, right? So you have to stay focused and do not engage into your trades. Don't actively look at your trades when you open them. Just try to stay away from the market as much as you can. Okay. If you can do it, please just stay away from your phone, from your computer. Go away and come back after a while. Or set alerts. Use alerts. Put alerts at your first take profit. Put alerts second take profit. Put alerts at your stop losses. You need to know what happens. Don't sit there and wait. When you hear an alert, you go and check it out. If it's your first take profit, what do? You move your stops to break even. If it's your second take profit, you move your stops to if it's your second take profit, then you're out of the trade and you're good, right? And you might reanalyze the charts and see if you're to re-enter another position when the market retraces. Or if it's your stop loss that gets hit, you come back and do it. You wait for the market, or you do your analysis again and wait for the market to maybe continue up if you were selling, or continue down if you're buying. Then when it comes back for a retest, you take an opposite trade on that particular key level. Good. So that's how you look at those things. We will go more in depth with these things. Like I told you guys, this is just introduction. So when we do practicals, it's going to make a lot of sense. So follow along and don't skip any part. Okay, the second point here, still, the best traders need to incorporate risk management practices to prevent losses from getting out of hand. Okay, if you're buying at point A and you're getting out at point B, nothing should make you push your stop loss to point C up here or point D all the way up here. Because when the market now be approaching your stop loss, you feel like, no, it's too tight. Let me increase it. Let me increase it. Let me increase it. You end up increasing all of your money on one single trade and you will be burned. These things happen a lot, right? Okay, so on no occasion or on no instance, for no reason, should you touch your positions when they are running. Leave them because you planned that trade before the trade even executed. So allow the trade do what it's doing. Allow it to play out. Give the market a chance, right? Having a strategic and objective approach to cutting losses through stop loss orders, profit taking, and protective puts is a smart way to stay in the game. Like I told you guys, I don't manually open my trade. I don't manually buy and sell. I don't do that. I don't manually, like when I wait for the market to enter here, I see an engulfing candle, buy or sell. I don't use those buttons. I don't use that option at all. Left to me, those buttons should not even exist on the MetaTrader 5 app. I use the limit orders, right? I use limit orders to place my trades. If I know that, okay, the market will come back all the way up here, then I'll place my sell limit and I'll leave. So that's like a trap that I've placed there and I'm waiting for my bait. I'm waiting for my prey to come, right? It comes in there, it gets trapped. So I set my limit orders in the market and I leave. Don't manually open. It's a poor way. So you need to be able to use these limit orders in your advantage. Because when you use limit orders, you have better entries. Because let's say you're waiting for this candle. Let's look at this one. Let's take this perfect example. This is a trade that I took I think last week before the markets were open. This is a limit order that I had here. And by the time this thing was being triggered, I was not even awake. I was not even beside my computer. I was far. I just saw the alert on my phone, right? So now let's say I was waiting to actively open buy and sell. At this time, I would have missed this trade because I was not there to buy and sell. So I placed my limit orders here. It's like a trap. I placed it last week, and this week it worked out. And it's like one of the best trades I've taken so far. As you can see here, with one single candle, the trade was done. The trade was done. So now let's say we're looking for some sort of confirmation to manually buy. Okay. Now, what are we looking for? We're looking for like the market to reject this area with an engulfing candle. So now look at this thing, and where is your engulfing candle? Your engulfing candle has not even formed yet. Because look at this push and there's no engulfing candle here. So you're still waiting for it to form. Then you buy. Where are you buying to? Here. Those are dreams that you make. These are like you are telling the market where to go, and the market does not do what you want. You cannot do that. Look at this one. Okay, let's say you're waiting for an engulfing candle here, right? This is one. Now, let's assume that that's your engulfing candle. Now you're manually buying here. When the market closes, pop, you open a buy position. Let's say put your stop loss, same here. Look at your stop loss. And now where's your target? 1:2. Look at that. What does the market end up doing? It comes back. So you cannot trade like this. This is very unrealistic. And these are goals that will never be attained. So as a successful trader, first of all, you have to set realistic goals. Don't say I want to make 5 billion by next year. Don't say I want to make 12 million every month. No, those goals are realistic, but just put realistic goals that you know that the worst comes to the worst, you can still attain them. You can still meet up to these things, right? Okay. So, like I said, continually, look at this trade that I took. I was asleep. It just came here, activated my order, and went straight to my take profit. Straight up. No stress. I didn't stress a finger on this trade. I just waited and I saw my money come to me. I didn't close any trade. I didn't open any trade. I just set my limit orders and I left. Okay, let's get back here. Let's look at some other points, right? So does it consider the 1% rule? This 1% rule, what does it state? A lot of day traders follow what's called the 1% rule. Basically, This rule of thumb suggests that you should never put more than 1% of your capital or your trading account into a single trade. You guys already know this point. I've sang it 1 billion times, both on my free Telegram and in the paid one, right? You should never put more than 1% of your capital on a single trade. So if you have $10,000 in your trading account, your position in any given instrument shouldn't be more than $100. This $100 here is 1% of $10,000, right? Good. You should not risk more than 1%. This strategy is common for traders who have accounts less than 100,000. Some even go as high as 2%. Okay? If you're going above 1%, your maximum should be 2%. But I'll tell you something now, okay? Me personally, I do not use 2%. I risk 1% on every trade I take. You guys know me very well for this one. I use 1% every single trade that I take. But I'm telling you that you can use 2% max if you can afford it. We might not be the same. You might be way, way richer than I am. So you might risk 2%, which is perfect. Don't go above that. If you go above 2%, I didn't say that. So 2% should be your maximum. I prefer 1%. I'm comfortable with that. If they can afford it, this is the key point here. If they can afford it, okay, let me put it in bold. If you can afford it, do it. If you cannot afford it, stick to this. 1%. Please, 1%. Okay? Many traders whose accounts have higher balances may choose to go with a lower percentage. That's because as the size of your account increases, so too does the position. So let's say you have $1 million account and I have like a $20,000 account or a $100,000 account. If you put 1% on a trade on $1 million and I put 5% on a $100,000, we are not going to make the same amount of money. You're going to make way more money than I am, right? So even though I'm risking higher, you are still making way more money than I am. So the key here is for you to have as much money as you possibly can. If you have much money, then you can risk a significant amount on just 1%. 1% of that huge capital you have there is still going to be good money for you, right? Good. Now, let's look at stop losses and take profit. What is a stop loss and a take profit? A take profit order is a type of limit order that specifies an exact price set by you. Your trading provider will close your open position or profit according to this price. A stop loss order is used by traders to limit loss or lock the remaining profits in an existing position. So if you are in a trade and you don't know when that trade is going to like end or maybe reach your target. You might have a target, but that target is not realistic because you don't have anything to say, oh, if the price is here, what will happen? You have to use stop losses. You have to use stop orders. Take profits as well. So when you open a trade, you put a stop loss. That stop loss now is like a point or a price, a very, very specific price, a specific price point. That if the market should trend all the way down, if it should drop to that point that you set, your broker or the liquidity providers, still the same thing, they will automatically close your positions for you, knowing that what you don't want to risk more than what you've put. So where that stop loss is and where your entry is, that space contains 1% of your capital. It's in that gap. So when the market will be dropping down to your stop loss, you will see the market automatically close. If you do not have these stop losses set, when the market drops down 1%, 2%, 5%, 10%, it will go down to 100% of your account is done. Then you'll just close your positions when you're out of business. So that's you losing all your capital. And what happens as a businessman when you lose all your capital? You go back to the village. Okay, when you have take profits now, how beneficial that is. If you have a take profit at a spot or at a point or where you know that if the market should reach here, the market might likely reverse. Or if the market reaches here, I've reached my goal. Because I've told you on every trade, set a realistic goal. I'm looking for 2% after this trade. I'm looking for 3% after this trade. That is a goal, right? So you enter, you say, I'm putting 1% and I'm looking for 2%. Because why? You need to make more than you risk. That's how business works, right? Now, you've put a stop loss. Your stop loss is 1 time and your take profit is 2 times larger than your stop loss, right? So now the market has run in profit. If you are not there to close it, the market will reach 1 to 2 and close automatically with the stop loss there. Without the stop loss, however, the market might reach your target and drop back to your stop loss and stop you out because you are not there to close it actively. And that's because you do not have a take profit. However, if you have a take profit, the market will reach there and close your profit. If you do not, the market will still reach there and continue up and give you way more money. It happens, but those chances are very slim. So you have to be very careful. Use take profit, okay? If you're there to actively close your position, nobody's going to sit there. Using my style of trading, I'm not a scalper. Scalpers, they can just trade like that and close back to back. I am an intraday trader, meaning I use the 4-hour time frame. Like the whole of today, I haven't seen any trade. So I will not trade the whole of today. Sometimes I hold a trade for like 2 days. So I cannot say at this particular point in time, the market will reach here. You cannot estimate the market like that. Some candles are very, very small and some are really big. So you need to be very, very careful. So let's continue now. Like I was saying, you need stop losses and you need take profits. That's because you might not be there like me to sit up and say, oh, I'll wait for 8 hours or 12 hours for this market to reach my take profit and let me manually close. So use take profit and use stop losses. Okay? I'll teach you how to do those things. Don't get confused. I said this video is strictly introduction. We'll go down to practicals and I'll show you guys exactly how to do it on your phone. And I'll also show you, I think I already showed you guys how to do it on my phone. So the video is up. You can scroll up, you see it. I'll show you how to do it on your computers. And I'll also show you how to, calculate your risk, calculate position sizes, and all of those things. I'll detailedly explain everything in the courses to follow, right? So be patient. Now, let's look at break even. When I keep using the term break even, not everybody knows. We might know this thing in economics, but in trading, it might be confusing, right? So this is break even here. What does break even mean? Break even is the point at which your trade neither makes nor losses money, right? Okay. It is also known as the price at which you have entered into a trading position. In terms of price action, it is the level at which the price, it is the level at which the risk on the trade is recovered. Let's say you enter a trade, let's go here, let's use this example. Let me use my trade here to illustrate this thing for you guys. Nice. Okay, you guys can see here that this red part here is my stop loss and the green part is my profit. So you can see that my stop loss here, my profit here is twice the size of my stop loss. That's to say, I'm risking 1 and I'm making 2. So I enter the market here. Boom. This is the price. You can see the price on this scale. Beautiful. That's my entry point. Now the market is trending. Let me replay this market so that I can explain to you guys how this thing really works. Let me go on a smaller time frame. Nice. Now let's look at this. You guys pay attention here. You see the price coming? Sorry, that was too fast. Okay, you see the price drop in here. Bam, with this huge candle, right? Now I'm in this trade because why? It has triggered my entry. It has triggered my limit order. Remember, I have a limit order here. I'm looking to enter the market when the market gets here because I'm comfortable that if the market gets here, there's a high likelihood that the market will bounce and go up. So I put my limit orders here, hoping that when the market comes, activate it and go up. So that's my plan for this trade. So that's exactly what happened with the next candle. Okay, now you see that this candle, before going up, this candle was trending in drawdown, and this could make like 2 hours here or 3 hours. And the last hour, it just goes up. That's how trading is. But now some people will like, oh, this thing, I'll close it. No, don't close it. This thing could drop all the way down here and still go up. Don't close your positions, okay? Let me get back to the point. I'm in here. This is my position. This black line is my entry, right? And this is my stop loss down here. So I placed the stop loss here and said, if my trade, instead of going up, it ends up, it ends up activating it and drops down. I want to make sure that if the market should reach here, I should close the market with these losses that I've taken. I should close with these losses. And let's say this is all my loss on this trade. If I do not have this stop loss set here, this market will continue dropping and my stop will be bigger and bigger until my balance, until my capital is wiped out. So that's why this is here, to stop the market from taking too much from your money, right? Good. Now my stop loss is here. The second that this price bounces up and reaches 1-to-1, that's if this market should reach half of this position size, which is here, around here, As the market has gone up and reached my 1-to-1, I move my stops like this to my entries. So this stop loss line that I have here, I'll bring it to this entry and set it there. So my stop loss and my entry will have the same coordinates. They'll have the same numbers here, the same digits. I'll input them on my MetaTrader 5 and I'll activate it, right? So my stop loss now will be here. So should in case this market should retrace back down, I want to get stopped out of this trade without making any money or without losing any money. Now, some traders will be like, oh, okay, why don't you just push this thing up maybe like here so that if the market comes back, it stops you out here and you've made some money in this space. Well, the market could stop me out here and still continue up and I will not be happy because this is all I've made. So I put my stop loss down here because I want to give the market as much breathing room as I possibly can. So I don't want the market to come and stop me out and go up. I'll be so mad. I prefer that the market stops me out at the break even. Then I say, okay, it is what it is. I can re-enter here. Depending on the market condition, I can still buy it. If I'm not comfortable, then I'll just wait. It might just go up and it might just go down, right? As long as my trade didn't work out, I'm out. So in this case now, I'm safe. When you break even, you are safe. So these are all ways you can manage your risk. This is how you can manage your trades and reduce your loss, reduce your risk on a position. So now the trade is running in profit until the trade eventually goes to take profit. You see how the market retraces, right? Now, this retracement here, those traders that I said, they are so impatient, they are scared to lose money. Their stop losses were here. What happened? They get stopped out here and they made maybe like $20 here. But now the patient trader who has his stop loss down here is going to wait and the market eventually give them money. So you see, before the market even gave you money, how many hours did he make here? You see, he made a good number of hours here. That's trading. So you need to be ready for these outcomes. So the market will do that. Then the market will eventually do what? Break up. So that's how I made it with this trade. And that's exactly what happened. So I want you guys to, look at all of this, go back and do some practice. It is very, very important that you guys should go through this video again and go through again so that I can pick out something valuable from it. And I'll see you guys in module 2. Part 2 of this particular module. So this is the first part. The second part now will be very, very practical. We're going to go into some calculations and how you can actively manage your trades while they're running. So thank you for switching in, and I hope you guys enjoy the rest of the course.